Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita and we're coming to you live from the Suzlon studio. Let me quickly take you through how markets are doing, and it's an IT day of trade, at least that's what it seems. Even though the Nifty is absolutely flat, much better than what we had anticipated. IT is perked up 3.7%. And to kind of quickly mark out LTM, which is the stock, or rather the company which came out with numbers over the weekend, you're seeing a decent move on that stock price as well, 2.5% higher. Let's go across. We're joined by Venu Lambu, who's the CEO and Managing Director at LTM, joining us this afternoon to give us a sense as to how the numbers are. You've sounded quite confident, Mr. Lambu, about growth picking up, especially from Q2, and then improving it further in H2. What's driving that confidence, and is it largely based on deals that have already been won? And there's a ramp up likely? Are you seeing demand improve more broadly? Give us the sense.
Firstly, the aspect about being confident on the growth is coming from the fact that two of our largest industry segments in our business have demonstrated a very good sequential growth. Both financial services and tech businesses have grown more than 3% on a sequential basis. I had indicated about financial services bottoming out in Q4 of last year, and then that's exactly how we translated into. We're seeing a good demand in two of our largest segments, so that's one indication. And the second is even in the consumer part of the segments, we grew 18% year on year. If there was no issue with regard to the Middle East or the delayed ramp up in the India projects, we would have grown even sequentially on the consumer segment. So the aspect of our leading segments is back to sequential growth is contributing to that confidence. And the second thing is that in the consumer side of the business, we did announce a very large deal. It's part of the vendor consolidation for the large global multinational based out of US. So that's going to ramp up in beginning of Q3 as well. So combination of all these three things is where the confidence comes about growth in Q2 and beyond.
After Q1 earnings, are you on track to still achieve the guidance for FY27? Will the growth be stronger than FY26 growth?
Well, I think I did mention about the base at which we will enter into the FY27 was is about 6% year-on-year growth that we had in FY26, and start working towards improving it. And that's exactly what we have done in Q1, right? On a constant currency basis, we grew 6.4% year-on-year. So we'll continue, getting better with that as we get into the Q2 and beyond. We don't give a specific guidance, but I did mention that the base is the same growth momentum as what we had in FY26 and get better on that. So I expect that to be better than FY26.
And North America, it's increased as a share of revenue this quarter. Are you seeing client spending recover faster in the US compared to Europe, and particularly around discretionary tech? How are budgets really shaping up? Could you give us a sense?
Look, the discretionary aspect of it, is common across both US and Europe. It is just that I do believe that, the whole discretionary spend is going to be redesigned from the clients. They're going to look at, a different level of priorities on the spending pattern. So the priority one is about all the discretionary spend that is oriented towards AI adoption, whether it's getting your data ready, modernizing your legacy, or even the talent transformation aspect of it, or building an agentic infrastructure, creating industry-specific SLM models that clients are focusing on using their data. So these are the aspects where there'll be prioritization of the spend. The second one would be, there are backlogs of the projects with some of the clients. They're looking for an environment with a better macroeconomic situation so that they can accelerate that. But at the moment, I see the priority is more towards the AI-centric or AI-related spend.
And AI revenue is now running at about $600 million odd and on an annualized basis. Could you give us a sense on what that actually consists of in terms of a breakup, and how much is coming from AI-specific programs versus AI being embedded in broader deals?
The way we look at AI is basically the four types of AI work that we do. Is the enterprise AI, which is all about infusing AI into the core IT services. The second is the business AI, where AI, gets into the core business process in redesigning and reimagining the core business process so that you enable the competitiveness of the clients, either in terms of enhancing the revenue experience or the cost aspect of it. The third is the creative AI, which is essentially addressing the CMO agenda in both content and the creative side of the entire marketing stack. And the fourth is the industrial AI, which is about addressing the supply chain or the connected products and connected manufacturing agenda for the clients. So these are the four types of AI work that we do. When we classify AI revenue, we look at the three ones, which is the business AI, creative AI, and industrial AI, which is about 12% of our revenue now. And we are confident to increase that. I expect that part of the revenue to grow faster than the company growth average. And in any case, as part of the 5-year strategy, we have mentioned about having 50% of our total revenue to come from AI native services, essentially around the three types of work that I mentioned. And today, incidentally, we announced a big partnership with Anthropic, to accelerate the cloud adoption, both at the software engineering side as well as creating industry solutions and reimagining the business process for our business AI. So and the partnerships like the one which we announced today with Anthropic is just going to accelerate our AI revenue.
And on that partnership, how should we think about it relative to your existing AI ecosystem? Is this mainly about strengthening your tech stack? Do you expect it to meaningfully improve your ability to win transformation deals? How should one look at this particular partnership?
Well, the partnership has two aspects. The aspect of creating, the skills and the talent base within our ecosystem. It's about co-creating industry solutions, and most importantly, leveraging our Blueverse platform and the entire Blueverse ecosystem in collab and using all the fantastic models that Anthropic has in creating the right knowledge fabric for our customers, creating the right agentic solutions, and building more new services layers for our customers. So that's one aspect of the partnership. The second aspect of the partnership is actually going together, to the customers in accelerating the AI deployment for our customers. So we're training our salespeople. In fact, we've sort of launched a very aggressive AI training for our sales organization to essentially capitalize all the opportunity that lies ahead in terms of AI adoption, and that's what I'm excited about it. And this partnership is going to help us both in go-to-market agenda as well as in our competency and talent transformation agenda.
Okay, and margins continue to be fairly stable for you, 15 to 16% range. What will drive margin expansion from here? Is there still room to improve utilization from here, 86%? You think future margin expansion will depend more on AI deals, pricing, operating leverage? What will it be?
Well, it's a combination of all the topics that you mentioned. Firstly, if you recall, we launched Fit for Future program last year, and that program helped us to get better on overheads, get better on our utilization, and it started a culture of redefining the cost of delivery. And this year, we continued that acceleration of redefining the cost of delivery with a program called New Horizons, which is all about challenging ourselves and the status quo and redefining what should be the right cost of delivery for different category of services. And we put all that under a program called New Horizon. So the benefits of New Horizon program, part of that was visible as part of the Q1 margin expansion, and the same thing I expect as we go into the second quarter as well. So that's one aspect of it. And the second is, the AI revenue is actually coming at a higher gross margin than the traditional core services. So that will also contribute, to our confidence about expanding our margins in Q2 and continuing it for the second half of the year.
And could you give us an update on the Randstad digital acquisition? Any outlook on the timeline for closing, and by when do you expect revenue synergies and margin benefits to start becoming visible?
So we expect the Randstad transaction to close in the beginning of Q3, at the end of Q2 or at the start of Q3. All the regulatory approvals are going as planned and as scheduled, including the consultation process. So our estimate at this moment of time is that we'll start consolidating from Q3 onwards, and at that point of time we will give you a lot more visibility in terms of the overall margin and the revenue from the day one.
Okay. All right, Mr. Lambu, thank you so much for joining us and giving us that perspective. Welcome back. We're joined by Pramod Gobi of Marcellus Investment Managers this afternoon to try and give us a perspective as to how they are looking at markets right now. Pramod, first off, great. A very good afternoon to you. Give us a sense, how are you seeing markets at this point, and especially this IT trade? Could it play out as at least a tactical buy opportunity currently, even now?
Thank you. Thanks, Harsh. Thanks for having me.
Having you.
Yeah, I mean, look, assuming this whole new West Asia crisis doesn't sustain, I think you'll have to make some assumptions. Otherwise, the markets the markets are as it is hard to predict, particularly from a short-term basis. But assuming it doesn't escalate and reverts very quickly, I think we can look at the markets from a more constructive perspective. I think we've had 2 years of almost no returns, so valuations have taken some sort of a time correction. And also at the same time, we've been through 2 years of very lackluster earnings. I think last quarter we thought earnings could have bottomed out until the whole crisis began to erupt. But assuming it doesn't, I think there is reason to be more constructive. Of course, unlike the period immediately post-COVID where there was a broad-based rally, I think we are looking at a more concentrated rally, particularly with quality coming back in favor, partly because in a relatively difficult macro environment, quality tends to do better as businesses are more resilient, balance sheets are stronger, ROCs are stronger, moats are stronger, and also quality isn't as expensive as it used to be right after COVID. So I think it'll be a more selective market. IT in particular, like you asked, I think it's a very tricky one. It is certainly cheap from comparison to historical multiple perspective, but it's also for a reason. There clearly has been lackluster in terms of growth. IT industry as a whole has come off from the high 20s sort of growth in the Northeast to low to mid teens, and now looking at least the large caps looking at high single digit sort of a growth. Partly the scale issue, but also having lost some share to GCCs. I think the bigger concern now is the threat of AI disrupting it. AI seems to be disrupting a lot of software businesses. The same seems to be affecting the IT services guys. I reckon, I think there should be a balanced approach here. Near term, of course, deflationary trends are clear. We're seeing it quarter after quarter. Impact of AI on existing projects is clearly deflationary. There is some merit in what the managements have to say in terms of AI creating new streams of business and new streams of revenues as well. The only question is the timeline on that. Is that going to happen now, or perhaps we're a few years away from it? I think the recent signs where a lot of software companies have said that the cost of tokens are prohibitively high. In fact, some of them have gone ahead and said that it's actually cheaper to employ engineers as opposed to the tokens. Could augur well for IT industry. Having said that, the long-term cost curve for tokens will also continue to come down. So it'll be a continuous grapple between labor versus capital, whether you're able to deliver an outcome cheaper using human engineers or with tokens. Net, we don't have any exposure to IT as of now. We are watching it very closely. Tactical, we don't do, so I'm sorry, I won't be able to answer that question. It is cheap enough. The rupee depreciation generally helps add a few basis points in terms of earnings growth, but the structural question still remains unanswered.
So, Pramod, quality, and that's exactly where I was getting at. IT is one of those bellwethers in terms of quality. If you're avoiding that, What is it that you're buying in terms of quality? Financials, I would suppose, in a big way.
Well, I mean, quality is more of a factor than sector. Naturally, IT historically was bracketed as a quality sector because it's a hugely cash generative business, beautiful business model with significant percentage of repeat or recurring revenues, high ROCs, free cash flow yields have been fantastic, even when the multiples were close to the 20s. So it did meet the quality factor. But one important aspect of quality is also the moat aspect, right? Whether the industry or the business model itself is protected against any sort of technology disruptions. And that we've seen not just technology, but even competition from GCC has clearly taken share away from IT services. So while it still remains a very high ROE, ROC business, although that is also changing in the margin with the sort of new deals that we're seeing, data center heavy, capex heavy. But clearly, the moat aspect doesn't qualify it for quality the same way it did. Similarly, FMCG as well, right? FMCG was also one of the first sectors you would look at when somebody said quality is making a comeback. But FMCG is also being disrupted because brand has been disrupted as a moat thanks to digital marketing, where plethora of venture capital has come and created D2C brands. Similarly, the advent of private labels from retailers such as DMart and Star Bazaar is eating into market shares of the frontline FMCG companies, and likewise Q-commerce and e-commerce. So quality needs to be segregated from the definition of sectors, instead looked at from a business fundamentals perspective. And we find quality companies across sectors. Leave aside the commodity sectors, say oil and gas, metals and mining, who don't generate ROCs significantly north of cost of capital on a cross-cycle basis. Outside of that, within industrials, within manufacturing companies, healthcare, pharmaceutical, chemicals, I think there's plenty of presence of quality, high ROC, moated businesses with significant opportunity to reinvest for future growth. However, valuations today are a bit of a concern. But having said that, relative to the rest of the market, which wasn't the case back in 2020, 2021, where quality was clearly trading at almost twice the multiple of the market, today isn't the case. It is possible to build a relatively, I wouldn't say cheap, but reasonably valued quality portfolio for consistent compounding in the future.
Very interesting. Pramod, what would I know that you're largely saying that there are bottom-up stories and there are bottom-up stories across sectors. So you're not able to talk about any individual stories, obviously. But talk to us about a sector which you believe could be the sector of the next 5 to 6 years, maybe where not all, but quite a few companies are getting underappreciated by the market right now, where there could be a good chance that things could unwind, maybe over the medium term. No tactical trades here.
Right. I mean, underappreciated would also mean that they are compellingly, attractively priced. But I think those are few and far between. Maybe private sector financials is where quality and attractive valuations reside. Growth has been a challenge. CASA has been a challenge for private sector banks. But having said that, I think there is still significant quality. And if the savings rate picks up, then CASA could also come back into play, and you could see an uptick in margins. That's perhaps the only place where you will see both value and quality reside. Structural trends, I think healthcare clearly ticks the box. Clearly, the post-COVID era where health insurance penetration has gone up has clearly improved the profitability of a lot of hospitals. Alongside that, diagnostics, throw in medical equipment and pharmaceutical and API companies. You have a fairly diverse basket to hunt for, where there are some really strong businesses run by really good management teams with high ROCs and moats. However, value isn't clear here, but it's clearly a structural trend. In some ways, it's also defensive because healthcare isn't as exposed to the vagaries of the economic cycle. So that perhaps ticks the box in terms of your structural trend without compelling valuation attractiveness. The other thing that we are seeing as a result of the developments over the last 2 years, where the rupee is depreciated, tariffs is a global issue, FTAs are being signed with the EU and the UK and a whole host of other countries, is the renaissance of manufacturing exports in India. India clearly missed the manufacturing bus. I think in an odd way, this rupee depreciation has a silver lining in the form that a lot of Indian manufacturing companies are finally finding themselves being competitive in the European markets, in the Western markets, and being able to take share from some of their peers in Vietnam and China and Bangladesh. That perhaps could be a structural story unless and until we shoot ourselves in the foot. It does need some sort of help from the government and the policymakers. But I reckon the reasons to believe the time for Indian manufacturing exports has come.
Financials, healthcare, manufacturing exports. Maybe these are areas one should look at. Pramod, also trying to address the other question with regard to the rally that we've seen among other markets across Asia, right? We've seen some very strong rallies in some of those markets, Kospi and Taiwan and the like, right? Do you believe that we're at the fag end of that and some of the froth may actually come off as a result? Also, how are you looking at earnings? You know, there's one section of the market which feels that earnings has now topped out and you'll see a sharp compression of earnings next year as this commoditization of chips starts to play out. Do you believe that that may well happen?
Well, it's hard to call this, right? Because this AI disruption has been unique. We haven't seen this sort of things. Some people might refer to the dot-com boom. Yes, there are similarities, but at the same time, there are very different dynamics working in this cycle. So I won't hazard a guess in terms of calling a top on the earnings. Having said that, I think it's a pretty narrow rally. Kospi is pretty much two stocks contributing almost 50% to the index. And we've seen memory cycles in the past. They are brutally cyclical, which is why despite the sort of profit growth they are printing, they're still trading at almost low single digits and high single digit sort of earnings multiples. Clearly, the market is wary of that. Having said that, is there enough new capacity coming which will suddenly start pulling down the prices of memory? It's not going to happen until late next year, really. But the markets are always forward-looking, so you never know. But that's a narrow market. We're talking about two stocks. I mean, Taiwan, literally one stock. So outside of this, there's still significant opportunity to invest, not getting bogged down by the AI trade alone. In fact, in the US, the market is increasingly getting broad-based, moving away. The Max 7 has actually underperformed this year and underperformed quite significantly. The Russell 2000 is the best performing index, so US small and mid caps. So that market is getting broad-based. And that's the beauty of a market like the US, which is very, very diverse. You will always find opportunities across sectors, even if you don't want to participate in the frontline theme of AI. Now, what does that mean for India? I think the bigger issue in terms of attracting foreign capital is the US bond yields. We've seen Indian FII data being healthy for a long period of time, almost 2 decades, but these 2 decades have also seen the zero interest rate regime play out at 4.5% 10-year bond yield for the US. The hurdle rates that a US allocator will need to invest in an emerging market, given the country risk, the currency risk will be that much more. So I'm not going to get excited about the FIS coming back, although I think valuations are a lot more attractive today compared to say 2 years ago. But yeah, I mean, we'll have to be more bottom up and fundamental in our approach. In some sense, the only factor which bodes well in terms of foreigners coming back is the quality renaissance. If quality comes back, and foreigners have always had a bias towards quality, if quality comes back as a play, then we could see some bottom up single country funds starting to buy Indian quality.
What's the just give us a sense, one market narrative today which you believe investors are accepting too easily and which will likely unwind maybe in another 2 to 3 years? What's your sense on that
one? Well, I think one of the things that people are saying is that India has finally financialized its savings, and the flow into domestic mutual funds will continue to keep the market quite elevated and prevent some sharp downside movements, which has been the case in the last 2 years, despite significant selling from foreigners. We have seen the market hold up, albeit it hasn't given much in terms of price returns, but we also haven't seen significant correction in the market, and thanks to the inflows from domestic mutual funds, we continue to see inflows. I'm not sure if that will be enough to sustain should the earnings growth doesn't pick up, should valuations don't get more attractive. Just believing that the flows will ensure that Indian markets will continue to give good returns for the long run, I think is a bit too strongly held belief, which could get questioned.
Thank you so much for coming in and speaking to us, giving us those views.
Most welcome. My pleasure. Thank you.
Very good having you here. Okay, thank you. We'll slip into a very short break. Come back. We'll bring in Kunal as well. Give us we expected. Markets are now staging a full recovery from the lows of the day and now sitting pretty in the green. We'll talk about that and more. We'll have Malana Sasalu, CEO of South Puravankara Limited, CEO South of Puravankara Limited, I beg your pardon, joining us on the other side of this break. Stay with us. We'll take those real estate trends on the other side.
Back with closing trades right here on ET now, and the magic really is within the Nifty IT index. That's the one which is really giving the index that much desired leg up. TCS is now scaling higher by 5.5%, 2170 plus levels in TCS alone. You got HCL Technologies giving a due company ahead of its numbers, a 4.25% of a bump up. TechM, Infosys all in tow, along with Wipro. And the good thing is that the strength is not just restricted to the large cap names. Look at a Tata Elxsi as well, for instance. That too is holding up 4%, definitely quietening down a little bit. Defense pack. BDL is the one which is under pressure today, down about 5%. And some of the other defense majors as well are seeing that bit of weakness. The other sectoral drags today are cement, chemicals, metals, etc. But the big news is that we've managed to recoup significantly and recoup most of all of our losses in the first half of today's trading session. And we're now nudging in the green as we speak. The breadth of the market as well as nicely opened up, while it's a smidge of favor in terms of declines, but still the technology contributions, some of the select dot names like a Voltas, which are higher by 4.5%, and Kalyan Jewellers, which continues to move from strength to strength. Another 8.5% off an uptick is what you're seeing on that stock. On the dragging end, of course, there are a lot of metal plays. Look at a Tata Steel, for instance. That stock is lower as we speak right now, so that's under pressure. More importantly, some of the broader market contenders, I mean, yes, BDL is one such large cap, which is under pressure, but many other names which are also cracking as we speak right now. Just going to bring up that list for you. Look at a GVT&D down about 3.5%. Indian Bank, which is down by about 3.5%. ICICI GI has been a weak one from the word go today. 2.6% lower for that stock. And pretty much, proportional to the cool-off that one has seen in gold. Look at a Manappuram. That as well is on a decline. It's down about 2.5% as we speak. Even within the large caps, the oil sensitives are the ones which are in the red. Maruti, Globe Aviation, Asian Paints, etc. are all languishing as we speak in trade. But let's just take stock of what else has been happening in the market. And, while that really is the sectoral flavor, it's good to see that some of the earnings contenders and the way they have been panning out. Look at a DMart, for instance. Inline set of numbers, but nothing to enthuse the market. That stock is lower by now, 2.25% as we speak. There's, of course, Biocon, very actively traded as well today. It's come off from the top of the day, cooled off, and then from the day's lows again, it's making a little bit bit of a comeback. Stock still lower by about almost 2.5% as we speak right now in trade. So that's pretty much the texture and the color of the market. But let's analyze Puravankara now and talk about how their quarterly update has been. We've got Mr. Mallana Sasalu joining in on the show right now. Mr. Sasalu, great to have you today on ET Now. Your first quarter numbers, they've clearly seen quite a strong pre-sale growth. Tell me, what have been the key drivers behind this robust number?
Thank you, Aisha. Thank you for having me on the show. Yes, we have had a very good quarter so far. 1,439 crore rupees of sales we did, as against 1,124 crores which we had in the same quarter of the last year. So it is again driven by, if you look at our numbers, at 1.25 million square feet is what we had sold in the first quarter of the last year. But this year we sold 1.36 million square feet, which is only 9% up the last year. The difference is coming from our realization per square feet from 8,900 rupees per square feet to we've gone beyond 10,200 rupees per square feet. So that is where the difference is coming up. The quality of the products has gone up. And also we've taken the prices up in several markets. So that is contributing to the outcome. Apart from that, we've also done very good collection this year. As against 857 crores, we've done 1,198 crore rupees of collection, which is around 40% up. So all in all, we've had a very good quarter so far.
But Mr. Sasalu, hi, this is Harsh here as well. So the guidance is to get you to FY27 pre-sales number of 11,000 crore. Am I right?
That is correct. So I think the second and the third and the fourth quarter are going to be stronger. If you really take a look at, if you take 11,200 crores and divide that by 4, it looks like the numbers are marginally lower. But we've not had any launches in this quarter. I think in the second quarter, we have lined up around 4 launches. And whenever we do launches, we have done extremely well. We sell anywhere from 30 to 50% of the stock in our launches. And then it goes into sustenance. So we're still confident about hitting our targets of 11,200 crores.
The launch pipeline for FY27, could you give us a sense of that?
So we've lined up around 14.77 million square feet for selling, and around 24,000 crore rupees is the total GDV of those launches. And it's around 25 projects to be launched. And out of which I think 7 or 8 are projects which are already launched, but whatever the remaining phases is going to be launched. Otherwise, 18 fresh launches are there, 14 coming from Bangalore, 3 from Cochin, and 2 from Chennai, 1 from Coimbatore, and 3 from Mumbai. So I think we are quite well spread this year, and also I think across the next 3 quarters you will see a number of launches that will be done.
The other thing I wanted to talk about, Mr. Sasalu, was the fact that your average realizations have improved significantly this quarter. Is this primarily driven by price hikes, a richer product mix, or would you say it's just overall stronger demand on ground?
I think all 3 of them combined. Basically, I think the products are a little bit richer, and I think that is where we are moving as per Puravankara. So that's one of the reasons. And the other one is the sales are strong and we've taken the prices up as well. And that's the reason the per square feet cost price has gone up.
Okay. And with regard to the collections as well, the guidance is double digit. Could you quantify that in terms of a number? I believe you did 4,200 odd crore last year. What would the full year guidance likely be? Because you've already done 1,200. I'm trying to understand whether that will be materially higher given the launches that you have in store.
See, the collections is a function of how much we are building. So as you can see that the collection has gone up by 40% in this quarter means that we are building a lot. That means we are hitting milestones consistently, and that's why the collections are up. For the FY26 full year, that we are looking at around 4,416 crore rupees of collection, as against 4,260 crore rupees last year. Because most of the projects are going to be new launches, which means that for them to reach a level wherein the collections are to become stronger, as you will see that the coming years, the collections are going to be stronger, and that is when the projects are going to get mature.
Okay, Mr. Sisalu, great to have you today on the show. Thank you so much for your time.
As always, Aisha and Harsh, thank you very much for having me on the show.
Okay, let's move on and let's talk about what the market texture is looking like. Given that it's IT all the way, there is a Kotak, Bajaj Auto, ONGC, ICICI Bank as well to some degree, which have contributed to the market recovery today. But Richard Jain is here on the show. Let's chat a little bit more about the market texture with him. Richard, hi, afternoon. What is it that you're making of this recovery on the Nifty? We've recouped all of our morning losses.
Yeah, hi, very good afternoon. So I think the good thing is that this price up move post that gap down opening has also been supported by good broad market participation. Many sectors, including the IT, which was one of the most beaten down sector, even the mid caps and the small cap stocks have been doing well. On the Nifty front, I think we have already formed a range of 23,800 to 24,500. This broad range is where we have already spent last one and a half month. Now, a higher bottom has been made around this 24,000, 23,800 range. Until this is intact, I think we would make another attempt to maybe breach that 24,500 or at least go towards that 24,500 again. So the short-term trend, although seems to be more of a sideways, but there is a good buying interest that is seen on any kind of dips that we are getting. So any such dips due to geopolitical news flows or anything, I think should be used as a buying opportunity.
What are the immediate levels on the upside with regard to the Nifty and the Nifty Bank that you would look at, Richard?
Yeah, so on the higher side, initial targets that I would watch out for would be around 24,500 to 600, where the 200 EMA as well as the previous swing highs are there. And that would be the major breakout level. If we get a good close above that, and I think we open up for the next leg of a move, which could be in the range of 600 to 700 points higher. Positionally, but for now 24,500 to 24,600 is what we are expecting or would be watching out for. On the Bank Nifty front, I think 60,000 is what one can expect on the positive side. In this recent dip which we received last week for a couple of sessions, the index managed to form a base around its 50-day EMA and has not been breached. So 60,000 should be the target for Bank Nifty index from here.
Interesting. But what about IT, Richit? After this up move, would you still venture to buy any of the names?
So I think yes, I think IT as a sector, if you look at the historical thing, what has happened over the last couple of years, we have seen a structural downtrend in most of the IT names or even the Nifty IT index. But always at the start of the result season, it becomes very important to see how the IT stocks react to this, when the heavyweights declare the results, with TCS, Infosys, HCLTech. So, whenever we have seen that the post-result reaction, irrespective of what the numbers are, depending upon what the commentary is or the post-reaction, the post-result reaction, whenever it's not positive. So that for next 2 or 3 months, we do not see outperformance coming in from the IT. Now, this time it's looking a bit different. What we have witnessed today or maybe last 6 to 7 trading sessions, from that low around 26,000, the stocks have already beaten down. Momentum readings on weekly, monthly are oversold. So I think at least a decent pullback move should be seen. So I believe that price-wise downside should be over or should be very limited from here on. May slip into a broad consolidation phase, not a sign of a big uptrend. It's very soon to say that, but at least downside seems to be limited from here for the IT names.
Okay, while the India-UK FTA comes into effect from 15 July, the India-US trade deal and some updates coming in on that. The Trade Secretary is stating that the trade negotiations are progressing well and that the framework deal with the US is now ready, will be signed at the right time. India-US are on the same page on the trade deal, don't see any challenges, disturbances, and that the deal is going to be signed at the right time. So while we're still unclear on timing, it seems that it's very much par for the course. Avi is here to highlight some of the other newsmakers this afternoon.
So some of the stocks buzzing in trade, I would like to start from Fino Payments, which is up by almost 9% since the new accounts that open have increased by 31% on a quarterly basis and is now stands at around 3.13 lakh accounts, and the average total deposits have also risen by 11%, now at around 2755 crore rupees. Up next is Just Dial, which came in as a surprise for everyone and is up by 20% since it has witnessed the fastest QOQ increase in listings, which is in the last decade, apart from the COVID period. They've also approved the appointment of Mr. Dinkar as the designate CEO, who is also a former Flipkart executive. So this was as a big positive development for Just Dial. Up next is TCS, which is also up by 6% as the company has signed a multi-million, multi-year AI deal with ABB. This will transform the global network operations. Also, this is seen as a sharp rally after a lot of correction in the IT sector. Plus, there have been a lot of senior KMP changes in TCS along with a proper AI head, and that is what is causing the stock to rally. Up next is Good Luck India, as the board has now approved bonus shares for the equity shareholders. Every one equity shareholder will receive 2 bonus shares for Good Luck India. Our last pick would be Tata Steel, which is seeing some selling pressure as it has received a notice from Dutch public prosecution has summoned a wholly owned subsidiary of Tata Steel in Netherlands for suspected criminal offence over alleged pollution at coke and gas plants. So that is the reason Tata Steel is seeing some selling pressure. TCS up by 6%, Good Luck India seeing some good buying, and Just Dial came in at a surprise, which is 20% up on account of good listings growth.
Okay, thank you so much for that, Avi. Ruchit, let me come to you with regard to your picks in a market like this.
Yeah, so since IT has started showing some signs of strength, one of the IT name that we like over here is Tata Technologies. Well, if we just do some comparative analysis of Tata Technologies and IT as a sector, if the Nifty IT index has bottomed out last week itself or has formed a significant low during last week, Tata Technologies formed its bottom in the month of March, during March end. So 4 months ahead of the sectoral correction getting over, the stock correction was already over. And in the recent dip, the stock formed a base around its 50 and 20-day DMA and now seems to have resumed its positive move. So during this last phase of down move in the IT phase, in the IT sector, Tata Tech was a relative outperformer. It was not falling. So if the sector does well, I think this stock should give very good returns from here on. So from a trading perspective, keeping stop loss below 720, traders can go long for potential targets around 850, I feel. And JSW Infra is another name where the technical structure has turned a lot positive. About 1 to 1.5 years of consolidation phase was seen. And finally, all the resistances have been taken out. And recent volumes have also been quite good along with the price of moves. So I think if this stock still has a long way to go. So JSW Infra can be bought with stop loss below 320 for potential targets around 410 to 420 in the short term.
Okay, the second one being JSW Infra, 410, 420 in the short term. So 20% from here, despite the 6.5% move on JSW Infra today. Let me go across to Kunal as well. Kunal, on the Nifty, did you expect this kind of recovery first off? And the IT index, very strong move. Did you anticipate any of this?
No, so I think on the IT index, not a surprise, but I think it's good to see that the majority of the action on the IT stocks is happening on a very shortened kind of a time frame, because after this kind of a sharp sell-off for these IT stocks, we're expecting more of a gradual pickup for these IT names, at least to start off with. But the data so far indicates that there has been a blend of short covering and I would say a slight increase in the delivery-based buying for these IT stocks, which could probably be one of the reasons why you're seeing that slightly high-paced price action move for these IT names. But for the index, it's been a spectacular recovery because, from, we were expecting the index to just about fluctuate or trade into a range around 24,000 mark, plus minus 1,500 points for the index. But it's good to see that the markets have recovered. Of course, on the back of strength and the recovery, which you've seen across many of the, major sectors. And I think if that's the case, then what we saw on Thursday and Friday after that Wednesday's correction for the market and today's recovery on the intraday price action, the probability now increases significantly higher for the index to show signs of a breakout, or at least we can say that support of 23,750, 800, which you tested on Wednesday, that now seems to be a very, very strong support.
Okay. And Kunal, what would your picks be in this market?
So I'll go with 2 buy calls, of course. The first one is about Deepak Nitrate. That's a very interesting chart. Coming back on the short-term basis, The risk reward extremely attractive. The stock at a multi-week, multi-month low on the short-term charts, confirming a trend line breakout on the medium-term basis. So we'd look at a target of 1750 on the stock price, stop loss at 1615. The second would be about Voltas. Again, a very interesting chart. The stock is on the verge of breaking a 6-month to 7-month of a downward sloping trend line, which could probably just end the downward pressure for the stock price and restart a major multi-month uptrend for the stock in the near term. So we'd look at a target of 1388 at least, stop loss at 1320.
Okay, Deepak Nitrite and Voltas, that's a buy call coming in from Kunal. Voltas, of course, is seeing a very big spurt in trade today. On that note, let's take a very quick break. When we come back, continue tracking markets with Ruchit and Kunal.
Welcome back and thanks for being with us. We have with us Nischal Maheshwari joining us at this hour. He's market expert and of course fundamental analyst. Kunal and Ruchit continue to be with us. Nischal, great having you. Really what we're trying to decode, Nischal, is what's playing out in IT. Sudden spurt in the index itself. You believe this is just par for course towards probably the stocks and the interest coming off again at some point of time in IT, or do you believe that now structurally things look a little more certain as the commentary starts to come in from some of the IT companies?
So good afternoon to you and your viewers. Basically, I still do not see any change in the commentary. The only thing which I see is the management not as pessimistic as they were in the last 2 quarters. And I think that is what is triggered this. But I think a bigger thing is basically has been the valuation and the sector being decimated in the last quarter, particularly in the last 15-20 days. And thereafter, basically, we've seen this kind of a rally. So I still believe basically this is a sort of a rally only. I don't see any fundamental change happening as yet, because you still do not know what is going to be the outlook on the sector and who are going to be the winners. So this is a broad rally, if you look at it, saying more of a relief rally than anything else.
That really seems to be the case right now. Though, Kunal, you're quite convinced about the move on IT, right? Does it look durable and sustainable?
It looks, Aisha, because at least the first part of it, that the sector required more of a short covering, that's now coming into these IT stocks. You look at the kind of positive candlesticks. Now, just to give a snippet over the last, I think, 7-8 days, there have been 3 major candlestick up moves for the IT stocks. And in those 3 big days, the IT stocks have moved on an average 3 to 3.5%. That's a substantial jump for these IT stocks in a very short span of time. When you try and compare this with the last maybe 1 month, 3 months of price action, we've not seen that this kind of an up move for the IT index at large. The other data is that so many of these IT stocks were into a deep oversold territory. There was a point where the Nifty IT index, the ratio or the pair chart with respect to the benchmark indices, even that was at a slight bit of an extreme. So the IT index was not just oversold, it was the constituents also for the IT stocks, which within themselves also posed a very strong degree of short covering kind of an opportunity. The initial bout of short covering generally lasts for a 10% upside when we look at it from a short-term swing low. And then what matters is if the news flow starts to become positive for these individual IT names, long-term investors, delivery-based buyers, they start to enter into the stock. So we need to see maybe phase 2 for these IT stocks, but at least the phase 1 so far indicates that it's a decent short covering at play.
Okay, decent short covering at play, and that's surely taken the Nifty IT index up, and along with it, the rest of the market as well, at least at an index level. But Meryl is here to highlight some of the other buzzers this afternoon.
That's right. These are some of the stocks that we've seen buzzing in trade today. Starting first with Bharat Dynamics. The company, now there's a new notification from the Defense Ministry, where the Defense Ministry is expected to invite bids from private players to manufacture the Astra Mark II Beyond Visual Range Air-to-Missile, which is a range of missiles Now, originally, the Defense Ministry did not usually accept bids from private players. So this is going to be changing the landscape for missiles manufacturing, which is why Bharat Dynamics is seen under pressure today. Moving on, TTK Prestige is also in focus. Normal manufacturing operations have been resumed for the company's Roorkee facility starting the 11th of July. Now the company is still assessing the potential damages to assets, including inventories on its books, but they have reassured investors that most assets and all assets are duly insured. Moving on, LTM is also in focus after reporting an overall in-line performance this time around. USD revenue in INR terms, EBIT margin and PAT all have come out in line for the company, with the company recording a flat US dollar revenue, which was more or less in line with the street's expectations. Also in focus today is Puravankar. After reporting their first quarter business update, they've seen pre-sales taking a gap up of 28% on a year-on-year basis. Collections as well have increased by 40% year-on-year, while the company has recorded sales of an area 9% higher than the last year's period. Intellect Design Arena is the last name that is on my list today. The company has announced 3 strategic customer wins for its eMAC AI custody. This is going to be reinforcing the company's growth in enabling financial services institutions to establish these modern custody and asset services businesses. So these are some stocks that we've seen in the spotlight today.
Okay, thank you for that, Meryl. I want to quickly also ask you, Ruchir, with regard to some of the other stocks which are buzzing outside of this IT pack. You know, the top gainers, of course, TCS, HCLTech, Tech Mahindra, Infi, but Bajaj Auto is quietly up 2% odd. From the auto pack, your top picks and this move on Bajaj Auto, you believe sustainable?
Yes, looks sustainable because of the volumes that we have seen along with the price that move. You look at today's volume, it's I think 2 to 2.5x what we usually see on a daily basis. So price up move supported by such good volumes are generally sustainable. I think we should see levels around 10,800 to 11,000 in the near term in Bajaj Auto. Apart from this, TVS Motor is also another interesting name where overall structure seems to be quite positive. After an price up move, some consolidation has been seen since last 4-5 days. A bullish flag pattern has been formed over there. So 3550, 3500 is a good support for the stock. So downside seems to be limited here too. So Bajaj and TVS are the 2 stocks which I think relatively if the auto as a sector does well, then there could be a good relative outperformance.
Okay, that's that on autos. In the meantime, just looking at the oil-sensitive trade, and today you're seeing just a little bit of ebb off actually on the likes of an Interglobe, Maruti, even Asian Paints for that matter. Ruchit, what's the take on Interglobe, for instance? Is it going to completely map the way crude moves and very swiftly be a buy on decline candidate always?
It has done recently at least. When the crude oil prices have corrected from that highs of around 9500 where some consolidation was there, we saw that the stock price around that time was around 4200. With correction in the crude price, back to below 80, the stock price have rallied from 4200 to 5400. So overall structure seems positive. Just a bit momentum readings are overbought on the daily time frame chart. So any kind of decline towards 5000, 4900 will make the risk reward ratio again favorable for this stock.
Okay. All right. Ruchit, thank you so much for joining us this afternoon, giving us your views and perspective. Appreciate it. Some of the other movers among broader market names, Kunal, TTK Prestige is perked up 4.5%, Good Luck India perked up 4%. Any names that are standing out from the broader market to you?
Yeah, I think TTK Prestige is something which, out of the 2 names which you mentioned, looks to be a little bit of a more stable chart. The stock formed a low of 400, 450 in the month of March. From there, it's been a consistent pattern of higher highs and higher lows. The stock is now on the verge of breaking above its first major hurdle point, which is around 685, 690 levels for TTK Prestige. The bigger resistance, however, is at 750 mark, which was also the high the stock had made in November, December 2025. And from where there was this 30% plus correction for TTK Prestige. So that's one level to watch out for the stock in the near term.
Okay, that's the take coming in on some of those buzzing names in trade. But Nishal, just wondering, given the news flow around West Asia, so volatile, its impact on crude even more, what's the right portfolio strategy, at least when it comes to some of the high beta and crude sensitive plays?
So I would actually now say basically buy on every dip. Because if you really look at it incrementally, market has started discounting this news. Yes, this kind of skirmishes are going to keep on continuing because both the players are trying to dig in their peats and trying to get a better deal out of it. But both the players are very clear that they do not have a stomach to go for a prolonged war. So this kind of volatility is going to continue. And that's why I think basically it's a good time to keep, whenever you see this kind of 500-point dip, which we saw on, I think, last Friday, it should be a good time to actually go out and buy.
Okay. You know, the golden question today is also this move on Kalyan. And Kunal, I wonder the 7.5% kind of move, what's driving it? How sustainable is it? 500? What should the and it's been a very stupendous rally, right? So can we continue to expect the stock to hold on to these levels?
Yeah, and for a surprise, yes, I believe that this rally for Kalyan Jewellers should hold on. Maybe I think you might see the stock going into a couple of days of correction because of this stretched rally over the last 4-5 days. But you know, the entire rally has been backed by some very strong delivery-based buying for the stock price, which is completely different in many cases with the kind of steep upprice trend when you look at the F&O positioning. You know, I was looking at the charts for the F&O's positioning for the July contracts. You know, when the stock was actually start to go into a correction around the 360, 370 mark. That time the open interest net for the current month futures was around 331,000 contracts odd. And now we are at a point, I think on Friday closing, we were at 333,000 contracts approximately. So that tells you that you know, there's not been too much of a change in the F&O positioning from the stock perspective. But when you look at the quantum of delivery buying, it started off with say 10 to 15 lakhs as an average delivery volume for the stock price, which till Friday jumped up to almost 2 crores for the stock. So that's a substantial jump on the stock price in terms of the delivery data. And that tells you that this move is backed by some strong, maybe institutional based activity. And those are the kind of rallies or the trends in the stock price, which takes the stock into much higher levels on the upside. What could happen, I would sense in my assumption is that for the next 2-3 months, maybe the stock could just about remain at this 500 mark, 480 band for the next couple of months. But then potentially for the next 2-3 months after that is where I would believe that the second round of up move could start off again into the stock.
Okay, that's the curious case of Kalyan Jewellers. In the meantime, let's take it across to Sajid and find out what else is happening in the F&O market. Sajid?
Thanks, Aisha. You know, the market's hovering about the 24,200 marks. And if you look at the Nifty, it's the IT index which is holding on to this level. Otherwise, all other sectors are in the red. If you look at the contribution of various sectors there. So the Nifty about 24,200 mark, premium of 31, and the open interest is marginally higher at 0.17%. For the Nifty Bank, we are seeing some shorts getting covered there. So the open interest is down nearly 1%. The index itself is up only 0.24%. But look at the constituents from a morning trade where we're seeing a shorts build up across the Nifty Bank constituents. Today in the afternoon, we are seeing some long buys coming in for ICICI Bank, Kotak, and SBI, except for HDFC Bank and Axis, where there's a short build-up happening. Across the board, we are seeing some long build-up or shorts getting covered in for the Nifty Bank there. Look at what's happening in call and put writing. Interesting trend coming in there. The put writers are digging in at 24,000, 24,100. There is a bit of a tussle happening at 24,200 there, but the index is about 24,200 at this point in time, and the distribution will show that currently, as we see, it's a neck and neck on the open interest part for the put writers and the call writers there. And that's what is something to watch out for in the next 20 minutes as we see some kind of rollover for the next week coming in, because tomorrow being the NSE Nifty options expiry there. But on the gainers front, Kalyan is the stock of the day, 7% up. TCS is another stock where we're seeing some shorts getting covered there, 5% up. Voltas is up nearly 5% in today's trade. Among the losers, you have stocks like BDL, short build-up happening. Indian Bank is seeing a long unwind, and Manappuram Finance is seeing a short build-up coming in there. Open interest gainers, again, Kalyan is seeing a lot of open interest build-up happening. 14.8% jump in Kalyan Law Avenue is the other one where we are seeing some shorts coming in at this point in time. 17.6% jump in open interest, and BDL is seeing over nearly 11% of jump in open interest as we speak. But in the loser side, you have Tata Elxsi, ICICI Pru, and Sona BLW, where we are seeing some shorts getting covered. But the most active stock today is TCS in the stock options. TCS 2200 July call, that's the most active one. See the unwind which is happening, 16.62 lakh contracts getting unwound at that strike of 2200 July call. The stock hovering around 2172, so that's also some resistance coming in for TCS to move above that level. So stock up nearly 109 as we speak. In the put side, we have Kalyan Jewel 4450 July put is also most active. The premium down nearly 5.75, and the open interest is up nearly 10.7 lakh contracts in today's trade. The stock hovering around 510 as we speak there. But as I said, the market seems to be flat, but it's the IT which is holding up the market at this point in time.
Yeah, that it sure is. But Nishal, curious to know the way Kalyan Jewellers has moved, the way Titan's commentary around its quarterly update as well was whether it's still a quasi-trade or a good one to the way gold prices are moving, or would you say because the ebb off on gold prices, maybe steer a little clear of these names? They're not going to give you as much returns as they did up until the March lows.
Yeah, so that is true basically, because I think both the stocks have run up quite a bit basically. I think Kalyan is up 30-40% in the last few days. So obviously they are not going to give you the same kind of returns. But with the falling gold price, basically the volumes start going up for most jewelers. Because as the gold becomes affordable, more and more people are there basically to go out and buy the jewelry. And they are in the business of jewelry basically. So I think that's where it is positive for them. And I continue to believe, I don't think so you are going to have the same kind of numbers which the industry has put out in the first quarter. But I think there is a strong demand as far as jewelry is concerned. So looks interesting. The whole sector looks interesting to me.
Okay, let me switch on to an ET Now exclusive. And PharmEasy's parent, API Holdings, is exploring a revival of its IPO plans. The company had withdrawn its earlier public issue in 2022 and is now evaluating a fresh market debut. My colleague Anurag Joshi is here to tell us more.
Online pharmacy PharmEasy's parent API Holdings is exploring the revival of its listing plan. API Holdings withdrew an earlier IPO proposal in 2022, and at that time it had cited the market conditions at that juncture as the reason for the scrapping of the plan. Then PharmEasy is one of India's biggest online pharmacies, and it was founded in 2015 by founders led by Siddharth Shah. PharmEasy's services include treatment and drug deliveries, diagnostics, teleconsultations, and also the offerings includes collection of test samples from home for deliveries to its labs. The IPO could help some of the older shareholders of API Holdings to exit some of their equity stakes. In 2023, the company API Holdings completed its rights issue, and in that rights issue, Ranjan Pai, who is a healthcare tycoon and controls the Manipal group, he had infused about 1,300 crore rupees into API Holdings, and now he has an equity stake of over 10%. He is the biggest shareholder in the company. So the 2023 rights issue size was to 3,500 crore rupees. To take you a little back, in 2021, API Holdings had filed its draft red herring prospectus with the Securities and Exchange Board of India, which the subsequent year it had withdrawn.
Okay, thank you so much for that, Anurag. I also want to quickly take a chart check, Kunal, on Pine Labs. That's the other one that's perked up, 7% odd in trade. How is it looking?
Yeah, so the short-term charts are still looking more of consolidative for Pine Labs. The major resistance for the stock on the short-term basis is around 165 mark. This is a level which the stock needs to be taken out for before it starts off and converts this short-term downtrend or consolidation into any kind of a meaningful breakout. The only positive part and rather a very interesting feature is that the volumes in the past 1.5 2 months from mid of May somewhere where the stock had seen a sharp correction, the volumes have jumped up significantly on the higher side. And in that scope of volumes moving up higher, the prices have actually consolidated in a band of 140 to 165. Now, essentially, to establish that a trend breakout has happened for the stock and this volume is more of a buying volumes, we need to see the stock to try and break past about the first immediate resistance, which is 165 mark. So even after this 6-7% up move for the stock today, I would still be more on the sidelines. I think 165 is the level to watch out for in terms of a potential breakout.
There are a bunch of names which are being talked about in the market about them being potential MSCI entrants. Loris Labs, Lenskart, Adani Green, Biocon, Coforge. There's Billion Brains as well, which is Grow. There's Apar Industries, Glenmark Pharma, Max Financial, Eternal, and then Uno Minda, which are being talked about. And most of these names are still a shade away from the kind of gains they need to clock in to qualify for the MSCI index. But just wanted to, get a sense right now, Nishal, on what is it that you're making about the pharma opportunity. Yes, they've had a decent amount of run-up already behind them, but would you still say that they're still undervalued? And any pockets within pharma where you think one can still buy afresh or even add on to positions?
So I wouldn't say there's anything in pharma is undervalued, basically. I think they're fully priced. But given their growth outlooks, I think some of these spaces will continue to do well, still going ahead. Personally, I like CDMO space. As I told you earlier also in the channel, basically, I'm invested in that. I own a few CDMO stocks in my portfolio. And that space, I believe, on a 2-3 year kind of a horizon still continues to do pretty well. And the opportunities are huge in the CDMO space. So that is one space basically which I like within pharma. And otherwise, the domestic hospital space is the other one which I like. So these are the two ones basically which I like as far as the pharma is concerned.
Is the one name which is clearly under pressure, and our researcher as well was flagging off this just a short while back, down about almost 4.5%. But Kunal, is this weakness at all rubbing on to any of the other defense names as well? And do you sense that they may get into a little bit of consolidation after quite a heady run-up that we've already seen?
No, not such, because I think most of the other defense names are actually showing signs of a decent recovery from the intraday charts. HAL, for example, the stock was down 1.5 to 2 percentage points at the start. That stock has recovered to be almost on the flattish note. BEL was one of the other names, which is down 1.5% at the start. The stock has seen a good recovery. It's come back from 408 to almost 412 levels. And same is the case with the other defense names. But I think for Bharat Dynamics, the chart patterns are still a little bit on the tentative side. We're seeing a double top formation for Bharat Dynamics on the short-term charts. The breakdown point or the support point for the stock was at 1330 levels. The stock seems to have broken the support. So till the time it doesn't reverse back and crosses about 1330 levels, I would sense that there could be a mild bit of an underperformance which could come back into Bharat Dynamics.
Okay. Nichal, I'll come straight back to the IT question and probably quiz you on ER&D. How are you looking at that pack? You've seen some good moves from Tata Tech, but some of the others, the likes of a KPIT, etc., of course, on the back of everything that the company has put out, doesn't look too positive. Do you believe that a turnaround of sorts could also start to play out, given that there's positivity in IT, could also trickle to ER&D at some point of time?
Yeah, it will happen over a period of time, but I think basically at the moment we are not clear from a broader services perspective itself. Because I was telling you, I heard both the calls. There is nothing basically for me to say that there is a structural change which has happened and the bottom has been made as far as IT is concerned. And we have clarity there. So that's why I'm saying this is the first thing will happen is in the services side where you'll start seeing some clarity. saying that, and then you will figure out basically who are going to be the winners in these broader services space. And thereafter, obviously, ER&D space will be there. But I have to caution you basically that the broader services IT companies, to me, I think on the valuation front have bottomed out. I do not see the same thing happening as far as the ER&D space is concerned. And that's why I'm a bit more cautious on the ER&D space.
R&D. Kunal, how would you rate this? You obviously have turned positive IT and you had waited. I mean, I recall when it was sub 26,000 on the Nifty IT, you said, let's wait and watch. Let a bit of a breakout come. Maybe you let the initial 5-7% go. What do you buy now tactically? Do you go for large cap, and within large cap, what names? Or mid cap, small cap, ER&D? How should you place yourself?
The best way in this kind of a scenario is we look at the statistical part and we look at the pair ratios or the ratio charts for many of these IT stocks within the IT basket. Now, for example, look at comparison between say ITC, HCLTech, TCS, etc., and this kind of a combination. It looks like that on the short to medium term charts that Infosys apparently is one of the stocks which is at an extreme with respect to HCLTech, TCS, as well as on Tech Mahindra front. So that tells you that Infosys is the one which is deeply oversold on the ratio charts. And when we see that kind of a extreme on the charts, it tells us that maybe Infosys could probably have a scope of a stronger outperformance. Of course, your time frame has to be at least 6 months to 1 year, if not more, for this kind of a scope of outperformance to play out. On the other hand, names like Persistent, Coforge, etc., the ones which have been relatively stronger. From that pack, KPIT Tech is apparently the ones which is extremely oversold. And again, at an extreme in terms of ratio chart. So the best way to try and play an oversold index, within the oversold index, try and bet on the oversold stocks, because they are the ones which generally tend to give you a slight bit of more alpha.
Okay, that's the take coming in on some of those IT names and where is it that there is opportunity right now. Just looking at some of the banking counterparts though, Indian Bank is down about almost 4.5% as we speak right now, or 3.5% actually, stand corrected at that. And the large cap banking names as well are not doing a whole lot today. HDFC Bank is still lower by about 1%. Axis is down 4/10. SBI is just about absolutely flat, though ICICI Bank has managed to recoup the early morning losses, and it's currently holding up by about almost 0.5% as we speak. But let's talk about some of the macroeconomic print, and we've got the India CPI numbers for the month of June, which are expected to rise clearly, driven by a weak monsoon, higher energy prices. Mitali, in fact, is here to tell us what the street is expecting.
Right, so India's inflation picture, it is back in focus, and the consumer price inflation, it is expected to rise above that RBI's target of 4% mark for the month of June 2026. The poll projects the headline CPI inflation to be around 4.3%, up from 3.93% that we saw in the month of May. The estimates range between 3.65% to 5.5%, and if this forecast holds, this would actually mark the first time in 16 months that our retail inflation has moved above the RBI's medium-term target. The key pressure points remain the food as well as the fuel prices. Weather-related risks remain critical for the food inflation outlook, while the higher energy costs as well as the geopolitical tensions could further add to the transportation as well as the logistic expenses. Core inflation, however, is forecasted to be around 3.95%, suggesting that underlying price pressure will remain well contained as of now. For the Reserve Bank of India, the message is clear that the inflation outlook is becoming more complicated. The central bank is expected to keep the repo rate unchanged at 5.25%. But if the inflation remains elevated, the economists see the possibility of at least one rate hike by the end of this year. Meanwhile, the wholesale inflation number, it is expected to be around 9.15%, highlighting continued pressure seen from the global commodity as well as the higher energy prices. So bottom line remains that India's inflation will now actually depend on the food prices, the monsoon performance, as well as the global crude oil markets, the movements there. And for markets, a sustained price hike or the rise in inflation could actually reshape the interest rate expectations, influencing the bond yields as well.
Okay, thank you so much for that, Mitali, for coming in and giving us that. But Nischal, one of the stocks that has obviously attracted investor attention today is Just Dial, locked in upper circuit. Would you look at a business like this now? differently at all? It's obviously got cash as much as its market cap. There's a change in leadership now. Of course, growth has been the concern, but outside of that.
So I think basically we have to look at in a different scenario. With the AI and all basically out there, I'm not sure actually how Just Dial business is going to actually eventually turn out. Because I think some of these things basically with Just Dial is doing, I think will get disrupted. And that is what my worry remains to be on Just Dial. For the moment, I think it is there, but one has to be cautious.
Okay. I also want to quickly mark out some stocks which are buzzing. I mean, we flattened, or rather we're closing absolutely flat on the index. Probably in the red as well, very, very marginally. But an RR Kabul, Kunal, that stock is up 7+% in trade. How is that one looking on charts?
Yeah, so what had happened is in the last 2-3 weeks, end of June and start of the month of July, the stock had gone through a decent correction from 2,500 as a top towards 2,180 as the support. So a decent 300+ point correction for RR Kabul, and that stock is now seeing a bounce back. It took support at the 50 moving average. We've seen this multiple times that when stocks go into a very steep short-term rally and then a correction, the correction generally halts in between the 20 and the 50 moving averages. And those are the points where contra traders or traders who would want to accumulate further into the stock price, they are the ones which generally buy into such stocks. So I think the base of 2,200 approximately is a strong support for RR Kabul. And the stock could now be on course of trying to retest the highs of 2,500 plus.
Look at Kalyan Jewellers. It's now clocking in almost an 8% of a move. And if we can just bring up the last 5-day chart on this stock, it's really been kind of mesmerizing, the move that one has seen on Kalyan Jewellers. And to think of it, this stock actually fell quite hard after its quarterly updates came in. And since that day, it's really been a one-way street for this stock. But closing in very strong for the technology pack, no doubt. TCS, Tata Elxsi, HCL Technologies, TechM, Infosys, these have all been stupendous winners. There's been a Bajaj Auto, Tata Motors PV, Kotak Bank, ONGC, M&M, ICICI Bank. These have been the leadership names. On the weak side, and by the way, the breadth of the market has closed in tilting in favor of the declines. Tata Steel, Nestle, Eternal, Interglobe, DRL, Maruti, BEL, these have all been laggards. But the bigger damage has come in from the names like a BDL, which fell about 4.5%, Indian Bank, which lost about 3.5%, GVT&D down 3%, Manappuram down nearly 3%, and Grasim as well, which was a rank underperformer with a 2.6% off a dip. Also saw a reaction to Avenue Supermart. Stock fell about 2.25% too. And then Biocon was actively traded today, 1.6% lower on closing bell, but it managed to definitely recover and move off the day's lows.
All right. Some numbers which came today, and I want to try and quickly pull out reactions to some of those numbers. Just Dial was the one right on top. 20% higher on that one. Fino Payment came out with an update. That one too is up 20%. LTM, L&T Finance were the other ones. Slightly more muted move on both of those, but in the green nonetheless. Avenue Supermarts was down 2%. Bajaj Consumer is the other one which came out with numbers, along with Kalpataru. And Bajaj Consumer, while the numbers were very strong, seeing some bit of profit booking playing out on that one. In terms of some of the other newsmakers which were buzzers, Swiggy is the one, 2.4% lower. That very strong move last week. Seen a bit of a reversal on that today. You're also seeing some bit of pressure on Ireda, Keystone Realtors. Those are some of the other ones which are taking a bit of a knock. Ajmera and Puravankara are the two stocks which are actually doing decently well. In fact, Puravankara did very well in trade. Ajmera up 1.6. That's the other one in focus. In terms of sectors, of course, it was all about IT today. But along with it, auto also eked out some gains. So did the PSU banking index, marginally, but nonetheless in the green. The metal index was choppy, 0.7% lower at close on the Nifty metal. But with that completely timed out on this edition of Closing Trades, before I let you go, Kunal, your take on the move today?
See, it was a good move for the markets because at a point where the global construct was extremely negative, the handover from the across the globe, the data points which transpired over the weekend was negative. It was very good to see the markets showing signs of recovery. However, I think we are still stuck into that 250-point range plus minus 24,000 mark. 24, 250, 300 is a major breakout resistance. Hopefully, I think this week, we may see that index finally breaking past about this major hurdle and then trying to lift off to the higher side of 25,000 mark. So I think it's more of wait and watch on the index front, but it's good to see sector participation improving. The stocks which were the underperformers in the previous leg of the markets, like HDFC Bank and the IT index, etc., these stocks have started to participate.
Oh, yes, they sure have. And finally, IT as well is contributing. But on that note, we'll wind it up right here on this edition of Closing Trades. Thanks for watching.